Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. You're tuning in for the Deep Dive, where we take today's biggest financial stories and really unpack what they mean. We've got a fascinating mix of articles from Bloomberg, the Wall Street Journal, and MarketWatch, and our mission is to cut through the noise and give you the crucial insights.
All right, let's jump right into it. The dominant theme across our sources today is undoubtedly the ripple effect of President Trump's new tariffs. The Wall Street Journal has an article, China's export orders plunge, hit by Trump's trade war. And it paints a pretty stark picture of the immediate impact. It details how China's manufacturing PMI, you can think of that as a kind of health check for factories, has dipped below 50 in April. That signals contraction.
Below 50, right? Contract.
Exactly. And maybe even more significantly, new export orders have plummeted. Lowest level since, December 2022?
Wow, so this really suggests that tariffs are biting into China's export-driven economy.
It strongly suggests that, yeah.
Yeah.
Hitting it hard.
And that announcement on April 2nd, Liberation Day, President Trump called it. Quite a statement.
It was. But as that same Wall Street Journal piece highlights, China isn't just, taking it. They're hitting back. Retaliatory tariffs on U.S. imports, sometimes over 100%.
Over 100%.
Yep. And restricting exports of critical minerals, too.
So it creates this real strategic tension. Beijing's under pressure. Stimulus, maybe.
Yeah.
But also figuring out how to respond.
Definitely. Pressure to stimulate, but also how to deal with the U.S. without, losing face.
And the potential scale of the impact.
Mm-hmm.
It's quite something. Goldman Sachs estimates, what was it?
Well, the journal notes Goldman Sachs estimating somewhere between 10 and 20 million manufacturing jobs in China are tied to U.S. demand.
10 to 20 million. That really underscores the stakes involved.
Yeah,
here.
huge stakes. Now, let's contrast this a bit. Another Wall Street Journal article, here's what is driving the rapid reversal of the historic market sell-off.
Yeah.
It shows that despite that initial tariff shock back in early April, U.S. stocks have, actually bounced back.
Right, I saw that. Seems like the tech giants, Apple, NVIDIA, they've been leading the charge. And maybe defensive sectors, too. Utilities, consumer staples.
That's exactly it. And interestingly, the journal points out something key. Phones, computers, other tech stuff. They were exempted from those huge 145% tariffs on Chinese imports.
Ah, okay. So that exemption is likely a big driver for those tech gains.
Seems very likely, but it's not, uniform optimism across the board.
No. Which sectors are lagging?
Financials, materials, energy, they're still behind. Suggests there's still a fair bit of caution lingering in the market.
Underlying caution. Got it.
Yeah.
What about Treasury yields?
They've stabilized somewhat, which, can sometimes reflect a bit of optimism, maybe a hope that these tariff issues get adjusted or sorted out eventually.
Well, for adjustments. But inflation concerns haven't vanished.
Not at all. Still persistent concerns there. And notably, the dollar has weakened, according to the journal.
The dollar weakening. Could that be investors rethinking the U.S. as a safe haven amidst all this trade uncertainty?
It's definitely a question worth pondering. Is confidence being shaken a bit? Maybe.
Okay, let's switch gears. Something quite unexpected, maybe. Bitcoin's performance. Bloomberg has this piece. Bitcoin outshines gold. Tech stocks in April amid tariff turmoil. This Bitcoin surged, around 12% since early April?
Roughly 12%, yeah. Outperforming gold and those recovering tech stocks.
So what's the thinking? Is Bitcoin carving out some kind of new role?
That's the really fascinating question, isn't it? The argument in the Bloomberg piece is that maybe Bitcoin is being seen more as an alternative hedge.
A hedge against what specifically?
Particularly against concerns about, say, U.S. fiscal policy or maybe the stability of traditional financial institutions. What's remarkable is after that initial dip when the tariffs were announced, Bitcoin actually kind of decoupled. It moved differently from other risk assets and rallied quite strongly.
Decoupled, so acting like a sort of digital safe haven instead of gold.
That's the narrative emerging. Traditionally, yeah, gold fills that role. But Bloomberg quotes Jeff Kendrick from Standard Chartered. He suggests Bitcoin might actually be more effective than gold as a hedge against financial system risks.
More effective? Why?
Because of its decentralized nature, apparently. He points to things like the SVB collapse, potential Fed interference, situations where Bitcoin's independence could look attractive.
That's a really interesting point. Decentralization is a key factor.
And there's more data. The Bloomberg article notes significant inflows into those U.S.-listed Bitcoin spot ETFs in April. Like $2.9 billion.
$2.9 billion in inflows? That's a big turnaround from outflows earlier, right?
A very significant turnaround. Shows growing institutional interest, perhaps. But, there's always a counterpoint.
Goes the caution.
David Lawant from FalconX, also quoted in Bloomberg, offers some perspective. He cautions against overinterpreting this decoupling based on just a few trading sessions. He notes the correlation with equity indices is still, relatively high, around 0.6.
Still pretty correlated then.
But he also observed Bitcoin's unusually low beta. That's how much its price moves relative to the market during recent stress. That could suggest a longer-term view emerging. Bitcoin as a more mature asset, maybe.
A more mature asset. Okay, moving from financial markets. How are these trade pressures hitting the real world?
Right. Bloomberg has an article, China looks to swap grains in feed with kitchen waste insects. Gives us a glimpse into some pretty significant adaptations happening.
Kitchen waste and insects in animal feed.
Yeah. China's planning a major shift by 2030, aiming to cut grain use down to 60%, soybean meal to just 10% in animal feed.
That's a huge change. Why? Just the trade war?
It seems heavily driven by it, yeah. As the Bloomberg article explains, it really underscores the food security angle. Retaliatory tariffs make U.S. crop purchases, especially soybeans, less viable.
So they're actively trying to reduce dependence on U.S. imports.
Actively. And this isn't brand new. It started accelerating during the previous trade disputes, but it seems even more intense now. They've set some ambitious targets, too. Big increases in non-grain feed production capacity, more quality feed grass. Shows they're serious about this shift.
It really sounds like a fundamental change in their approach. Okay, so this uncertainty, it's not just governments worrying, right? Businesses, too.
Oh, absolutely. It's having a very tangible impact. The Wall Street Journal, again, trade war uncertainty prompts wave of companies to yank forecasts. It highlights major U.S. and European companies, GM, JetBlue, Snap, Volvo, Mercedes-Benz, Stellantis. Big names.
And what are they doing?
They're either withdrawing their future performance guidance completely or just not providing any, specifically because of these unpredictable trade conditions.
Wow. Just pulling back forecasts entirely. That really signals how deep the uncertainty runs for businesses. Hard to make even short-term predictions.
Exactly. This lack of visibility, it's a major red flag for investors, obviously. And the journal reports even UPS.
UPS, the shipper.
Yeah. Predicting lower shipping volumes, lower revenue. They're laying off 20,000 workers. Their CEO specifically mentioned the unprecedented potential impact on trade.
20,000 layoffs. That's huge. And financial institutions.
HSBC, Deutsche Bank, they're setting aside more funds, provisions for potential loan losses, directly linked to the uncertain economic outlook fueled by tariffs.
So banks are bracing for impact, too. But is it hitting everyone the same way?
Not uniformly, no. That journal article does note Nucor, the U.S. steelmaker, is actually seeing a positive effect. Stronger order backlog, likely due to the tariffs on imported steel.
So tariffs helping some domestic producers.
It seems so. And Volvo Cars apparently anticipates higher tariffs will stick around, so they're implementing cost-saving plans now.
So different industries, different impacts. Makes sense. The article also mentioned a survey about executive concerns.
Yeah, widespread concern among senior executives across party lines, actually, worried about the broader political and legal climate impacting their businesses. Trade is a big piece, but it's part of a larger uncertainty puzzle.
That broader concern is telling. Okay, so while companies navigate this, earnings season is also happening. What's the market reaction been like?
Mixed, really. Bloomberg's article, Stocks are mixed in build-up to big tech earnings, notes the broader U.S. stock rally kind of paused. Investors waiting for numbers from Microsoft and Meta.
Holding their breath for big tech. Any notable moves so far?
Yeah, MarketWatch reported Supermicro computer stock took a pretty sharp dive after hours, lower than expected revenue and earnings.
Supermicro.
Yeah.
Any reason given?
Well, Christopher Wood from Jefferies, mentioned in the Bloomberg piece, suggests there might be issues for big tech beyond just tariffs. Maybe overspending on AI?
Overspending on AI. Does the MarketWatch piece on Supermicro give more detail?
It does. It suggests delayed customer platform decisions, likely tied to the big transition to NVIDIA's new Blackwell chips, and also higher inventory reserves for older products. That combo seems to have caused the miss.
The Blackwell transition.
Agreed.
Creates a tricky period for companies in that space.
Seems like it. MarketWatch notes HPE executives made similar comments about the shift to Blackwell-based AI servers, causing some delays or adjustments.
Okay. Any other earnings news jumping out?
Bloomberg reported Yum China also missed profit estimates.
Yum China. KFC and pizza out there, right? Why the miss?
Increased promotions. It's a competitive market. Consumer sentiment is weak, so they used promotions to drive sales, but it squeezed their margins.
So sales held up, but profits took a hit from discounts.
Pretty much. Same-store sales were flat, and restaurant margins actually improved due to cost-cutting, but the promotions bit into the overall operating profit. They are still planning more store openings, though.
Interesting balance, trying to grow while managing costs and weak consumers. Okay, looking ahead to the big tech earnings, Amazon, Apple, Meta, Microsoft.
Right. MarketWatch had an interesting opinion piece. What options trading is telling us now about Amazon, Apple, Meta, and Microsoft earnings? It looks at options prices, specifically straddles, which are basically bets on a stock making a big move up or down. The price reflects expected volatility post-earnings.
So what are the options suggesting?
According to that analysis, Amazon's options are pricing in potentially a more significant move compared to Apple and Microsoft.
Bigger swing expected for Amazon. What about Meta?
Meta's options suggest a higher risk-reward profile. It has a history of really big post-earnings swings, but they haven't always been consistent in direction. So more potential, but maybe more uncertainty too.
Fascinating way to gauge market expectations right before the reports drop.
Definitely. Now, shifting topics again, an interesting angle on gold. With prices near record highs.
Yeah.
MarketWatch had an article, "If you love gold at near record high prices, why not wear it?" It explores the idea of high-purity gold jewelry, like 24-karat bullion jewelry, as an actual investment.
Investment jewelry. How does that work?
Well, apparently it's more common in places like India.
Yeah.
The idea is the jewelry is valued primarily for its gold content, minimal markup, so it acts as a store of wealth you can wear.
Unlike most jewelry here in the U.S., which has lower purity and big markups?
Exactly. Gleason from Money Metals points that out in the article, but he says they're seeing more interest now in this investment-grade jewelry in the U.S. Sales are up.
Interesting trend. What about tariffs and jewelry?
Okay.
Gold itself is exempt, right?
Gold bullion, yeah, usually exempt. But jewelry often isn't. And
Yeah.
since a lot of it is made outside the U.S., those tariffs are hitting manufacturing costs for jewelers.
Oh, okay.
Ah.
Fix the finished product cost.
Right. And on a related note, another gold story from Bloomberg. Quite unique.
Go on.
Uber's Middle East unit, Kareem, is delivering gold coins. 24-karat gold coins right to your doorstep in Dubai.
Uber delivering gold. Seriously.
Seriously. They partnered with the jeweler, Tanish, and the timing isn't random. It coincided with the Hindu festival Akshaya Tritiya.
When buying gold is considered auspicious.
Exactly. Clearly targeting the large Indian expat community in the UAE. It's just another sign of gold's strong appeal as a safe haven, especially with this trade war expanding.
Delivering gold. Wow. Okay, let's talk broader market strategies. That old saying, sell in May.
Yeah, Bloomberg brought that up. Old wisdom of sell in May back in focus as stock market churns reminds us of that historical trend. Historically, the S&P 500 tends to have lower returns between May and October compared to November through April. Lots of analysis over decades shows this pattern.
So does that old wisdom apply this year with everything going on?
Well, opinions are divided. Some analysts think, given the volatility, maybe the pattern holds. But others argue that in this tariff world, the trade talks are probably a much bigger driver than seasonal trends.
So maybe tariffs trump seasonality this year.
Could be. Past performance isn't always predictive, especially with major geopolitical stuff happening.
Speaking of caution, what about Mark Mobius? Bloomberg reported he's holding a lot of cash.
A lot of cash, 95% according to the report. The veteran investor is taking a very defensive stance because of trade war uncertainty. He thinks it could last, 6 months.
95% cash. That's extremely defensive. Does he see potential anywhere?
He mentioned India long term, and maybe China if there are shifts in trade and consumption policies there. Interestingly, he still expects the S&P 500 to rise by year-end, despite his cash position now.
Cautious now, but maybe optimistic longer term. What about oil markets?
Bloomberg reports oil traders are bracing for another potential supply surge from OPEC plus Ivan, led by Saudi Arabia.
Another one. Why?
The thinking is Saudi Arabia might push for higher output to discipline other members who are overproducing, kind of like a surprise hike they did back in May.
To enforce quotas, maybe? Any political angle?
Potentially. The article mentions it could align with strengthening ties with President Trump, who generally wants lower fuel costs.
And what happens if they do boost supply?
Well, we saw crude futures plunge after the last increase, so it could mean lower prices, which might help consumers at the pump, but it could cause financial pain for oil producers. A tricky balance.
Definitely tricky. Okay, so we have trade wars, potential recession talk, but stocks have climbed recently. What gives?
Yeah, MarketWatch tackled that. Why are stocks climbing when a recession looks more likely? One possible reason they explore is that maybe the market has already priced in some of the damage from a potential mild recession linked to tariffs.
Priced it in already.
That's the idea. They look at historical median S&P 500 declines during recessions, noting recoveries have often been relatively quick afterward. The article also points out the S&P 500's negative performance during Trump's first 100 days, maybe suggesting some initial policy jitters are already factored in by now.
So maybe the worst fears are accounted for, but there are still risks.
Oh, definitely. The concern is that a weakening economy plus all this uncertainty could still cap the upside for stocks, not necessarily smooth sailing ahead.
Right. And speaking of politics and uncertainty, the debt ceiling fight.
MarketWatch covered that too. Trump's tax cuts hang in the balance, why the stakes of debt ceiling fight are higher than ever. It explains the potential Republican strategy. Link a debt ceiling increase to making those 2017 tax cuts permanent. Their narrow majority makes this a key leverage point.
Using the debt ceiling to lock in the tax cuts. What hinges on the timing? That X date.
The X date when the Treasury literally runs out of maneuvering room is crucial. If it hits late July, that might favor Trump's push. If it slips later into the fall, it could get more complicated, potentially needing Democratic concessions. It's high-stakes political timing.
High stakes indeed. Okay, a couple more quick hits. Spain's power grid.
Yeah, weird story from Bloomberg. After a nationwide blackout, the chairwoman of Spain's grid operator claims Spain actually has Europe's best grid, blaming generation problems, not the network.
Vest grid? After a blackout. How did that go over?
Well, the company's shares dropped significantly. She had a meeting with the prime minister, but she refused to resign, saying it would imply the company did something wrong.
Wow. Okay. And finally, Starbucks. Something about free money.
Sort of. MarketWatch pointed out that the total value sitting on Starbucks gift cards and loyalty accounts is massive, like $1.85 billion.
$0.85 billion.
Yeah. It's essentially an interest-free loan to Starbucks from its customers. Plus, they recognize breakage revenue from cards that never get fully used, nearly $208 million last year alone.
$208 million from unspent coffee money. That's quite something. Okay, so wrapping this all up, we've got these really diverse, sometimes contradictory signals. Bitcoin maybe as a new safe haven, China making these deep internal shifts due to trade, companies yanking forecasts because of uncertainty. It really makes you think, how should individual investors even navigate this kind of complex environment? Are we seeing some kind of fundamental shift in how assets correlate, how we assess risk?
Yeah.
There's definitely a lot to consider.
Absolutely. Our deep dive into today's financial headlines from Bloomberg, The Wall Street Journal, and MarketWatch really reveals a global economy grappling with significant shifts and uncertainties. The interconnectedness of trade policies, market reactions, corporate strategies, it's clearer than ever. We definitely encourage you to keep exploring these topics and think about their potential long-term implications.
And with that, we'll see you all tomorrow morning with new headlines from major financial magazines.